To write a weekly piece for nearly 30 years assessing investment risks and rewards, geopolitical implications, and extracting signal from noise requires experience, knowing what matters, good instincts, and the ability to talk to the right people. The weekly piece in question is Greed and Fear, and its author and our guest today, Christopher Wood, Global Head of Equity Strategy at Jefferies, based out of Hong Kong, has been ranked #1 equity strategist in the Asia Money polls for 18 years since 1996. Formerly of CLSA, he lives across Asia and other parts of the world, and I hope today he will offer us a different and longer lens on a complicated world. So Chris, I was gearing up this morning to talk to you in Hong Kong, and then suddenly you give me a call saying you've landed and you come to the office. So it's a great pleasure to see you here in person. Welcome.
Very good to see you, sir.
Well, it's always a treat when a friend comes on the show, and you and I have known each other for over 20 years. I read your work as part of my essential weekly investment diet, and you have the distinction of having outworked most, if not all, of the best investment strategies of the last 3 decades. You worked for the Economist from 1984 to 94. You were both the bureau chief in New York and in Tokyo. And as I was thinking about your career, you're kind of the financial equivalent of those war reporters who get themselves into the epicenters of conflict, because you were in New York for the S&L crisis and the 1987 crash. You arrived in Tokyo as the epic bubble burst in 89-90. You went to Russia, I think, when privatizations were taking shape with Morgan Grenfell, but you'll correct me if I'm wrong. And you've been in Asia to witness the huge changes from China to India and beyond. Let's look at Hong Kong and more broadly China. Can you distill China's ambitions and appetite? By which I really mean, what does China want and how far is it prepared to go to get it?
I have a very different view from the view of China currently being spun in the US and Western media, because they're kind of assuming China is territorially expansionist, which is not my view. There's nothing in Chinese history to really justify a view that China wants to be territorially ambitious. China's just trying to promote a strong economy. It wants to control its own area. It wants to be the dominant power in the Southeast Asia, but it's not what I would call territorially ambitious. What it has done is it's been trying to create economic linkages through its various Belt and Road projects, but that is not territorial. That's not a military expansionist doctrine. As one African dictator apparently was reported to have said, when talking to the Americans who were complaining about them doing stuff with China, he said, the Chinese build us airports, you give us lectures.
Well, one of our other guests now, Ferguson, he said Xi Jinping is ideologically a true communist leader who believes in the one-party state, hostile to Western notions of free speech and representative government. China embarked on an ambitious plan for world power manifested through the One Belt, One Road initiative.
I look at it a bit differently than that. To me, the Chinese believe in reciprocity. So basically, the Chinese have got the Chinese wanted to create the equivalent of the old Silk Road. Their SOEs are very good at building infrastructure. Now, there is an argument that sometimes they lend the money in a way which leaves these countries on a hook. So, they're subject to the charge of reverse colonialism. But the reality is, Pakistan's now got a lot better infrastructure than it had before because the Chinese have built this infrastructure.
Got it. Now, if we step back from China, because there are what I guess was termed the axis of evil, we have this coalescing of political views. You have written, I'll quote you, tectonic shifts are occurring at least as great as the collapse of the Soviet Union in 1991. But while that event provided a peace dividend, today conflicts are driving global military spending to record highs. Is this the brave new world we must navigate? And if so, how?
Well, I think from a market standpoint, this is the biggest risk to markets. It's not Fed policy or GDP growth. The biggest risk right now at the end of the second quarter 2024 in world markets is quite clearly geopolitics. And it's extremely hard for markets to discount geopolitics. In fact, markets are useless at discounting geopolitics. They will always hope for the best, which is natural. So actually the markets will only react when hit in the face with these developments. Right now, I'm not really concerned about this Taiwan-China thing. The two key risks right now, where both situations are escalating, is Middle East and Russia-Ukraine. Personally, I'm more concerned as of today about Russia-Ukraine because there's a dynamic which creates the risk of escalation in the near term. Whereas I think in the case of the Middle East, I don't see why the Israeli leader would want to really escalate in the next few months because of the US presidential election. That will just be irritating Washington. But in the case of the Russia-Ukraine situation, there's a very rational incentive for the Ukraine government to try and escalate things as much as they can, because their incentive is to try and trigger direct NATO intervention in Ukraine prior to the presidential election, because there's clearly a 50% risk that Donald Trump's elected, and based on Donald Trump's statements up till the recent past, we should assume he will want to stop funding the Iranian war effort. Ukraine can only win this conflict if they get more and more NATO intervention.
Does that arrest Putin's ambitions to push up and out?
Well, yeah, this is a controversial subject, but I used to do Russia. Personally, I don't believe this. I don't buy this rationale of Russian behavior that it's expansionist and wants to take over all of Europe. My personal view is complete nonsense. What's quite clear to me is that, and clear to far more informed people than me, like Henry Kissinger, that it was always clear that Ukraine joining NATO was a Russian red line. This has been, James Baker, the very incredibly capable Secretary of State under the first George Bush presidency, promised that NATO would not move 1 inch east. So there's been several moves in NATO eastward in the intervening period. The Russian leader has been very clear in his comments on this. If you read the memoirs of Mr. Burns, who's the former US diplomat who was served as ambassador in Moscow, did 2 terms in Moscow, is now fortunately head of the CIA. It's quite clear where he comes down on this issue, i.e. he said it's a red line. So actually the only good news right now is that he's running the CIA, because I'm assuming he hasn't changed his mind dramatically. So yes, I don't accept this narrative. So to me, this is a very dangerous situation.
So almost more parochial, and yet in some ways very important because it sits on our doorstep. We may have the Euro football championships going on, but we have these fissures in France as it seeks, possibly a new direction. How seriously do you take the developments as a threat to the Eurobloc?
The danger to the EU will come if we get a German reaction, Brexit-like a German reaction against funding the rest of Europe. Because the right wing of Germany is increasingly criticizing this whole European setup as a transfer union. So the key fault line in European politics is not France, which is dominating the headlines right now. The fault line that matters is Germany.
So let's go back to Asia and let's go to Japan. You know it really well. It's a key Western ally, which, is sometimes forgotten. But let's just talk about it from an investment perspective. I think you've written 3 acclaimed books while you were at The Economist, on various parts of sort of, the Japanese bubble and bust. And I was talking over the weekend to a lady called Patricia Jabwick. She was in the 80s and 90s, one of Wall Street's early and foremost female trailblazer. And she said, how do we reconcile this Japanese position of being the largest creditor nation in the world and yet this huge debt to GDP?
Most of the Japanese government bond market is domestically funded. So the big difference in the US Treasury bond market and the Japanese government bonds is the Japanese have not been reliant on foreign creditors. Second technical difference is the duration of the bonds is much longer than the US. That's the reason why the Japanese government bond market hasn't blown up, despite all the predictions that it would do. But in the recent past, the bond yields are now rising. So my personal view is bond yields are in an upward direction in Japan. But it looks right now that the stresses is not really going on the bonds, it's going on the yen.
The yen is probably the cheapest currency in the world when measured on long-term valuation measures. What's your view on how this plays out?
I would have been inclined to buy the yen in the fourth quarter of last year because it looked like the interest rate differential of the US and the yen had peaked. But the problem is that the BOJ, in my view, is being too cautious about tightening monetary policy. And this is raising the risk that they lose control of the currency. And from a technical chartist standpoint, the yen has now broken a level which sort of shows potential for unlimited downside. So I think the next BOJ meeting is extremely important. They need to get on with raising rates. Now, they're scared to raise rates because one, of the domestic economy might weaken, but two, they're scared of the debt servicing costs on the government budget. But there is a potential way out of here because the Japanese financial institutions now, in my view, the bond yields have reached a level where actually they can buy, if I'm a Japanese life insurer, if I'm Nippon Life, I can buy JGBs at current yields, 10-year around 1%, where I can meet my asset liability requirements in yen, which means I no longer have to do what I've been doing for the last 30 years, buying offshore treasuries and other G7 government bonds, hedging the currency and trying to generate extra return. So the BOJ owns 55% of JGBs outstanding. So they have a willing buyer of these bonds if they can have a smooth rise in yields, but not a volatile one. The risk, though, is that they're too slow to normalize and they lose control of the yen.
And let's just pause on the stock market. Again, it's a little bit of the US phenomenon. It's been dominated by a relatively small number of companies that have driven it up. We had an interview on our curated channel with Arcus. I think you know Peter Tasker and Mark Pearson, and they were making the case for the extraordinary value in the small and mid cap.
Well, that's all worked.
That's all worked. Foreign investors have been the one driving, this push, haven't they?
Yeah, no, the foreign investors have driven the Japanese market. My own Japanese portfolio is, for the big caps, is 30% in bank stocks, and that's been working up till now. But obviously, there's a risk that you, from a foreign perspective, you lose everything you gain in the equities, you lose in the currency. But from a Japanese domestic standpoint, the Japanese institutions have still not reallocated out of yen fixed income into Japanese equities, which is incredible.
What will make them?
Well, they should have already done it. What will make it when they realize for 100% conviction that deflation's ended and inflation's back? All the evidence is that inflation is back, but unbelievably, they have not reallocated to Japanese equities yet. If they do if they suddenly all decide that inflation has finally returned, they'll all reallocate at the same time. That's the way Japan works.
So again, let's just put the investment lens on wider Asia. Is there, for global investors listening, a must-own in Asia?
The must-own in Asia, which I've been saying for 20 years, but I would still say is the Indian stock market. So for the last 20 years, I've been saying the Indian market's the best market to own in emerging markets, I would say globally, because India is now in a sort of similar to position that China was at the beginning of this century in terms of the demographics, in terms of the GDP per capita. And you have a very dynamic entrepreneurial culture in India. You've got a huge number of interesting companies. You've got a very dynamic stock market culture. You've got the most dynamic asset management industry globally after the US. The Indian market in recent quarters has been driven by surging flows into domestic mutual funds. Emerging market global investors are barely overweight India. Not because they don't like India, but it's because the valuations are high and the market's been driven by domestic money. And global investors, as opposed to global emerging market investors, don't even own India. So everybody knows India is the next big story, but nobody owns the market. So that's definitely my view as the key market to own long term.
But if you're a contrarian, you would say that a lot of money has pivoted from China to India.
No, but it hasn't. Sorry.
It hasn't.
No, because they kind of, all the global money that own, because what happened about 2 years ago when Russia was effectively cancelled as a country and also as a stock market. So if you were running a global emerging market fund, the vast majority of them had Russian stocks. So suddenly your Russian stocks in your global emerging market fund were marked down to zero, even so they're still trading on in Russia, and Russia was kicked out of the benchmark index. So since that event, it's been in the back of everybody's mind that the same thing could happen in China. I'm not saying it will happen, but All you need is a New York Times report that the Americans have proven that China is supplying weapons to Russia, and the whole potential for China to be kicked out of the benchmark arrives. So global investors who don't need to own China, as opposed to global emerging market investors, all basically sold their Chinese stocks. They didn't buy India because they're not set up to buy India, because to invest in India, you need to get the relevant regulatory approaches. And there's very few ADRs listed in India. So the global money, global money owned China because all these Chinese ADRs are listed in New York. So the global money exited China and all went into Japan. So the Japanese markets been the big beneficiary of flows out of China, not India.
But if you are, I want to just stay with that contrarian investor, Hong Kong, you know it really well. It's a super cheap market. Lots of good companies that by long-term measures of returns on equity are great value. Is the political risk sufficient to just say, I don't need to go there?
No, in terms of domestic Hong Kong, that I would own domestic Hong Kong's on the floor. The stocks are incredibly cheap. Well, I'm not talking about mainland China. I'm talking about domestic listed Hong Kong stocks in the Hong Kong economy. To me, if you're a value investor, these should be bought. But there's no near-term catalyst for performance.
Got it.
And I don't believe Hong Kong is finished, which is another narrative.
Yeah, let's stay on that, because it's easier to say, the expats have gone, it's the contract's been torn up. Why are you quite constructive on Hong Kong?
The practical reality is Hong Kong's still the most efficient place to function, particularly in the financial world in Asia. It's just extremely, extremely efficient. And all this political stuff hasn't negatively impacted that. And, it's also become much cheaper, although it's not cheap relative to Shenzhen over the border, but compared to Singapore, it's extremely cheap. I'll give you a practical example. If you're a foreigner or a corporation and you're buying a residential property in Singapore, now you pay a 60% stamp duty. 60%. In Hong Kong, you now pay 0.
Okay. Which brings us to your recommended long-term portfolio. So for some time you've run, should we call it an endowment portfolio, which is a paper portfolio, but it's how you would allocate what you don't want to own and what you want to own.
What I don't want to own is I've believed since March 2020, when in my view, the Fed and other G7 central banks went bonkers by printing all this money to deal with a pandemic, which is a medical emergency. That, in my view, then, is that the G7 government bonds, led by US Treasury bonds, but also gilts, JGBs, etc., entered a bear market. So my firm recommendation is that people should not own G7 government bonds. So we've got a bit of a rally going on right now, which is a good chance to exit. If you're a US investor and you have to have exposure to long-term bonds, I would recommend owning long-term bonds of US corporates, which have far superior balance sheets to the federal government.
So these are AAA, or investment.
In my view, it's a matter of time before the highly rated US corporate bonds trade through treasuries.
Okay,
i.e. the yields go below treasuries.
That's not a view we've heard expressed, by our guests. So that is definitely interesting. Now, one of the things that I have been drawn to is that you, like myself, are a gold bull with a large allocation, but you, unlike me, are also a Bitcoin bull. Help us understand and reconcile those two positions.
Well, I just think they're complementary, Simon. So they're both, I believe they're both stores of value, but I certainly wouldn't only own Bitcoin, but I think it's very risky to only own gold. Because for one practical reason, there's a demographic reason. There's a real risk if you own gold that millennials will never buy gold. They won't probably buy gold mining stocks either, because many millennials have, in my view, exaggerated obsession with the negative environmental aspects of mining.
So although there is a plan by the World Gold Council to go through this digitalization of gold program?
The World Gold Council is trying to do tokenization. I think that makes a lot of sense and to be applauded. But But Bitcoin, to own Bitcoin, you basically have to believe in the Bitcoin model, or you have to believe that there's a limited, constrained supply of Bitcoin, which at some point ends. Because Bitcoin has a built-in quantitative tightening dynamic, which gold does not have. So if you believe, which I do, you either believe that or you don't. If you believe in that Bitcoin formula, then it's definitely a store of value. I would also say that Bitcoin's been really stress tested. And probably the biggest stress test of Bitcoin and the whole crypto world was when that
SBF
blew up. So to me, and the great virtue of the crypto world, and actually the great negative of the conventional world, is there are no bailouts in the crypto world. So we have market clearing, and that is an extreme positive. Probably the most insidious thing that's happened in global financial markets since, I would say, the late 90s is this, what I view as shocking culture of bailouts, which basically leads to ever greater socialization of credit risk. But I also think this culture of bailouts has now had political consequences. So what I call the chattering classes have been, making all these critical comments about the so-called populists, and you're reading a lot about the arrival of the so-called far right in the Western world. But the practical reality is this whole political movement represented by Donald Trump or Nigel Farage or the various actors in Europe. What's given rise to this whole thing was what happened back in 2008, because ordinary people realized then there was one rule for Wall Street and one rule for Main Street. And this, I think, has fundamentally damaged belief in the system, most importantly in the US, because in the US, there's a very strong culture of backing free markets, capitalism. And this has been really, really badly damaged by what happened in 2008. And that's why these movements are so strong. And, and we still have this very insidious culture happening, this bailout culture. You saw it very clearly. Most recent example of this bailout culture was, when was it? When was Silicon Valley Bank?
The spring of last year.
Yeah, so what happened with Silicon Valley Bank? The Federal Reserve created this lending facility. This is a technical subject, but it's important to understand. They're lending money to US banks, but they're lending the money valuing the collateral at par. That's a total, what's the word?
Cop-out.
Total transgression of normal central banking principles. So I was talking to the governor of a major prominent central bank in Asia. I won't say which, but one of the most important countries. I said, you wouldn't do that, would you? And he had to admit, he said, there's no way we'd do that. So there's a fundamental lack of market discipline now in the G7 world, which is very, very damaging.
And for anybody who didn't listen to it, just in December, we interviewed Michael Lewis, who was the author of Going Infinite, who had lived sort of almost alongside SBF, and we had an interview with Ravi Joseph, and it was very funny because of all sorts of things, and an absolute, for those who didn't listen to it, please do listen to it. Now, attached to all of this lack of orthodoxy in the central banks is the government's own fiscal profligacy. Now, you've written, in fact, just in last week's piece, and I'll read it out, the Congressional Budget Office, the CBO, on the 18th of June said that it is raising its forecast for America's fiscal deficit this year to 1.9 trillion. That's up by 27% from only 4 months before. Now, what are the consequences for the dollar of what's going on?
Well, to me, the issue is going to be the US Treasury bond market. Okay. Because the key question is, do supply concerns start to influence the Treasury bond market? Because in the last several decades, G7 government bonds have not traded on supply concerns. They're basically traded on what's going on with nominal GDP. But in a world where people start to get seriously concerned about the sustainability of these deficits, there is a risk that the market demands a premium because of the supply risk. And I think late last year, we saw the first early signs that this could be happening to US Treasuries. But I would say as a practical level, you need to get the 10-year yield reaching 5%, which it touched last autumn to start this moving the market. And you can see that in the percentage of what debt service payments are as percentage of government receipts. And they're at the highest level since the mid-90s. But you can also see it on the growing addiction in the US to issuing short-term paper. So they've been issuing paper, I think, below 1 year, but about 80% of the issuance from memory has been below 1 year in the US. So you've got this very contrasting situation in the US where the big US corporates are really smart. They refinance their debt in pre-pandemic at all-time low, near low bond yields. So they've locked in their debt. Whereas they've been smart, the federal government's done the exact opposite. It's more and more reliant on short-term paper. So I think the real vulnerability will show up there first. But for now, all we can say is the CBA has highlighted the fiscal situation in the US is out of control, and neither presidential candidate has any interest whatsoever in discussing fiscal retrenchment.
So it is clear that you are, I'm very sympathetic, not wanting to own G7 bonds, but you have recommended buying investment grade credit.
And the other thing I own is emerging market. If you've got to own bonds,
yep.
I believe you should own emerging market government bonds in their own local currency. And I've had that recommendation since the Fed went bonkers in March 2020 by printing all that money. So I have a global sovereign debt portfolio, which entirely consists of local currency emerging market government bonds, which has massively outperformed G7 government bonds. And the reason, very simply, is the emerging market central banks are much more responsible, and the emerging market governments are much more responsible at running their fiscal monetary policy. Why is that? Because if you're running the central bank of India, Philippines, Brazil, you know, unless you follow good behavior, your bond markets will be blown up by foreigners exiting because you're not following orthodox policies. However, in the G7 world, there's this belief or custom that they are risk-free securities, therefore they can behave however they want, and people keep buying their bonds. And this is basically a custom. It's got no foundation in logic. And in my view, this whole concept of G7 government bonds being risk-free is illogical and nonsense. And it's a convention that at some point is going to be stress tested. You're already seeing early signs of it. But there's a practical issue here because the post-global financial crisis regulation of the Western banking system is based on the premise that G7 government bonds, be it treasuries in the US, gilts in the UK, are risk-free. And they're not risk-free. So that means the regulation's built on a fundamentally erroneous concept.
Those sentiments were actually echoed by Rob Arnott last week in one of our interviews, and with Manny Roman at PIMCO, about the opportunities in the emerging market local debt space. Now, at the other end of the spectrum, you've been writing about what one might describe as your concerns or trouble brewing in the world of private credit. Tell me a little bit about why you are getting more concerned.
Well, it's more private, yeah. What's interesting about this monetary tightening cycle in the US, because at the end of the day, the Fed has raised rates more than at any time since Paul Volcker crunched 1970s inflation in the late 70s. So the question is, although many people say it's not that big a monetary tightening cycle, it's a lot bigger, more rate hikes than most people anticipated when the Fed started raising rates. So the interesting question is, who's been hurt by higher rates in the US? Now, the interesting thing about the US stock market is that US corporates' net interest payments have collapsed in this Fed tightening cycle, which is counterintuitive, but it's true. One, because the big tech giants have cash on the balance sheet, so they're now earning 5% where they used to earn nothing. And the other reason is many listed corporates, as I just said, refinance their debt. Similarly, while subprime households in the US are definitely suffering, the reality is US households in aggregate have not been that badly hurt by higher rates. One, because most Americans have fixed rate mortgages. And the second point is the baby boomers are actually enjoying it because they're now getting 5% on their cash balances, which they used to, for many years, they got nothing. And actually the cohort above 65, based on the recent data we have, has massively increased its share of US household spending. So who's hurt by the higher rates? In my view, the real stresses from higher rates are in the PE world, which is the world which boomed, private equity world, and private equity is the industry that boomed more than anybody else with zero rates. But the thing about the PE world is it's not regulated. So if there's a problem in the PE world, it's not like there's some bank regulator is going to demand a provisioning, because bank regulators don't exist in the PE world. And the other point about the PE world is that when a PE company does a leveraged buyout and buys a company, it doesn't borrow the money itself. It puts the debt on the company it's purchased. So these leveraged loans they use for the leveraged buyouts are linked to LIBOR. So the rates have risen a lot. They've not hedged the interest rate risk in most cases because they didn't borrow the money. The target company did, and that's where the pain is. But as I say, they're very good at financial engineering. So there's a lot of weaving and dodging going on. And the other point is that there's a big booming asset class now called private credit. And while the American commercial banks have turned risk averse in the last 18 months, loan growth has slowed. The interesting point is how resilient the US economy has been. And I think there's two explanations for that. One is the big fiscal deficits, and the other is there's still lending going on through this booming world of private credit. And the IMF did a report the other day, which is the best thing I've read on private credit so far, and they're estimating about 70% of private credit is going to fund private equity. So while investors have become risk averse about giving more money to private equity, be they public pension funds, family offices, they are still pouring money into private credit. But the bizarre thing, the ironic thing is by pouring money into private credit, they're lending money to private equity, which is the area they've now become risk averse on.
Yeah. I was at Super Return in Berlin a couple of weeks ago, and there were definitely conversations going on about more complications around the private debt space, as in there seem to be the beginnings of workouts and complexities.
Well, the last thing in the world I want to allocate any money to is I would actually allocate money to private equity before private credit, because at least private equity is you can allocate money to a private equity fund now at a discount. But the bull case for private credit is the following: you're getting very high returns. The average return is about 12%, according to the IMF report. So you're lending money between 10 and 15%, and you're senior in the capital structure.
So I'm going to ask you some shorter general questions. Love your thought, first of all. ESG. Do investors care in Asia?
No, actually, investors never really care. But ESG was always huge in Europe, has been for the last 20 years. I would say in America, I think ESG as a movement peaked in the fourth quarter of 2021, along with the renewable stocks. By that time, it had become very big in America. Since then, though, ESG has become part of the political divide. So if you're one side of the political equation, you like ESG. If you're the other side, you think ESG is horrible. Whereas in Asia, I would say, almost, the Asians in ESG, there's rhetoric. Obviously, there's never really been a big thing in ESG in Asia. It was always first and foremost a European phenomenon.
And although, of course, all of our good financial education tells us we must have balanced portfolios or diversified portfolios, if you could only have one position for the next 5 years of any asset, what would it be?
Only one? No, I think it would have to be gold.
Okay.
But I mean, the question is it gold or Bitcoin?
Okay, well, Nick Carey of blockchain.com, who's been a guest on the show, is also very articulate on that matter. Chris, I'm intrigued because you write weekly and you write in depth, and I don't know how many thousands read your piece. Would you know how many thousands read your piece? It's, it's become, as I said, a sort of a staple diet for people like myself. But it's a lot of work, and also it requires you to be relevant. How do you source your ideas, and how do you sift what is, a lot of noise going on? How does that change much?
No, that's not very different from being a journalist. It does help when in my job, I'm meeting a lot of investors, so that's clearly clearly also helpful, though during pandemic one didn't meet anybody. But I have a colleague who's been helping me do the charts ever since I started. So I couldn't do it without that. Because, you're basically running it on journalistic deadlines, right? So...
Got it. Now, you produce these portfolios. They are paper portfolios. I know that they're audited. Do you sit there sometimes going, the ultimate thing I need to do is actually have a dedicated pool of capital that I run myself?
Now, the ideal thing would just be to print my portfolio and just have someone just implement it.
Right.
Because if I actually became the technical fund manager, then I'd be running into the risk of being bet on the sell side and the buy side. You see what?
Got it.
The only guy who pulled that off was your former colleague,
Barton Biggs.
Barton Biggs, my great friend Barton Biggs, or the late Barton Biggs.
So I've got 4 very different questions. I listened to you talk about Zoom, and you said it really isn't very helpful unless you know the person, and you typically conduct your discussions on the telephone line. Is
Yes.
that right? Is that right, and why?
Yeah, because I think there's nothing wrong with the old-fashioned telephone. In fact, it reduces a lot of distraction. I'm not a big believer. I think Zoom's fine if you know someone. I think it's very. I don't think it's the most important. The technology was the telephone.
Is that because people are looking at each other and not looking at what's in front of them, or they're not listening, or?
I just don't think it's relevant.
Okay.
I mean, I see nothing wrong with a conference call on an old-fashioned telephone, preferably on a main line. So the problem is people don't have main lines now. This is a problem.
Yes.
Again, if I want to edit a document, the best way to edit it is on a fax machine.
Why?
No, because you print out. You're going to edit if you're proofreading a document, you're much more likely to find typos, inaccuracies if you read it on a page than on a computer. It's just a reality.
Right.
As any,
Yes. Now we are just starting a mini series on sport and finance and the intersection. We've recorded, and it may be out by the time you're the co-founder of Strava, and we're going to have some asset owners. I mean, these trophy assets or sport assets, is this hype? What did you think? There is an investment case for owning sports franchises?
There is, but in the particular case, obviously, what makes, to me right now, people ask me what's the importance of the UK globally. I think the UK as a financial centre has massively reduced importance, partly because of the self-inflicted goal of Brexit. So actually, what's the most important franchise in the UK right now? What's the UK most well known for? And the answer is the Premier League. But if I get in a taxi anywhere in what used to be called the third world, and I say I'm English, then 9 times out of 10, the next question is, what team do you support? So there's no doubt this is a very valuable franchise. But there's a risk, because what makes the Premier League such a great franchise is also all the fans. So obviously the long-term risk is the fans are priced out. And then you lose the atmosphere, which makes the Premier League unique. So that, to me, is a risk, because the commercial logic will be going in one direction, but that's going to lead to fans not being able to afford to go. So I think that's one issue.
And you are a stated long-term Chelsea fan. What's going on there? Is this really a sort of is there a front for the Saudis?
No, I got no idea that time. But what I can tell you is, obviously the fans are not comfortable. But obviously the fans in Chelsea, I've lived close to Chelsea all my life. So Chelsea achieved a level of success in the last 20 years, which no long-term Chelsea fan could ever believe possible. But right now, I think a key issue is going to be the ticket price. Yeah.
Got it. And Chris, finally, who's been your most important mentor?
Well, the chap I worked with as an undergraduate, on John Greenwood, he was obviously a long-term mentor. Actually, Barton was a good mentor of mine too. Barton, as in Barton Biggs.
Got it. And I am going to ask you a last question, because we have a large cohort of young listeners as well who think about journalism, finance, medicine, all sorts of things. How would you reflect today on somebody thinking about just finance or journalism?
No, I would tell them actually, because the problem because I get, people just graduate asking me to help. And oftentimes it's very hard for them because these HR departments now dominate and they have these tick in the box criteria, which makes it very hard for people to sort of get around. So I think you need to go as far away from that, you need to go in a very lateral direction. So oftentimes you're going to get the best opportunity by just physically moving.
Physically moving to another geography, be that.
Where something interesting is going on, and where, you're going to have a much faster learning curve.
And that actually, we had John Authors on, and that was pretty much his message as well.
So right now, let me just think. Yeah. So let's say I would say one obvious place which is changing dramatically, and there must be a huge number of job opportunities, is Saudi Arabia.
So I'm going to summarize. I've written down a number of things here. You articulate your view that you want to own crypto alongside gold, and you make the point there are no bailouts in the crypto world. I can't imagine it. I think it would be, anyway, we won't go there. You rightly comment, and I think many of us feel this, there's been one rule for Wall Street and one rule for Main Street, and that has been an important cause of the political divide and the reaction.
But particularly in the US, because in Europe, a lot of people don't believe. It's not like every Brit or Europe believes in capitalism. But in America, you can be poor, but you believed in capitalism, right?
Number three, emerging market central banks are significantly more responsible in their behavior than their G7 counterparts, which is one of the reasons you would prefer to own their debt rather than G7 debt.
And the finance ministers.
And the finance ministers. Your concern about the private debt world stems from its lack of regulation, its disintermediation of the banks, the lack of provisioning, the avalanche of money. And so that is definitely not an area that you want to be.
But, to be fair, back in 2009, I think it was a really smart idea to invest in private credit because the banks have been massively regulated, right?
Yeah.
And there was a huge gap in the market.
Yeah. Chris, thank you for coming in today, and it's been great to talk to you.
Thank you, Simon.
All content on the Money Maze podcast is for your general information and use only, and is not intended to address your particular requirements. In particular, the content does not constitute any form of advice, recommendation, representation, endorsement, or arrangement, and is not intended to be relied upon by users in making any specific investment or other decisions. Guests and presenters may have positions in any of the investments discussed.